Hi guys! In this video, we're breaking down the basics of options trading in a way that's easy to understand, even if you're a complete beginner. Options might sound complex, but once you get the hang of them, they open up insane profit potential. Imagine turning $50 into 5 million. That's kind of upside options can offer you if you know what you're doing. But here's the catch. Just as quickly as you can make life-changing gains, you can also lose everything in a flash. So what exactly are options? Unlike stocks, options are contracts between two traders that let you bet on price movements without actually owning the asset. This means you can make money whether prices go up, down, or even stay the same if you play it right. Let's break it down with an example. Imagine a trader who believes Tesla stock will skyrocket in 3 months. We'll call him Tesla Bull. He thinks that market is underestimating Tesla's true value and wants to cash in if the price rises. But instead of buying Tesla shares outright, he finds another trader, Tesla Bear, who believes the stock is overpriced and will drop. These two traders make a deal using an option contract, allowing them to bet on Tesla's future price without ever touching the actual stock. The Tesla Bull and the Tesla Bear enter into an agreement that outlines their views, giving the Tesla Bull the right to buy shares from the Tesla Bear at a predetermined price, known as the exercise price. For instance, if the agreed upon price between them is $165, Mr. Bull has an option to buy the stock at $165 after 3 months. Now, let's say the stock price at the end of 3 months is $190. The bullish trader stands to gain $25 from the agreement, as they can buy the shares at the agreed upon price of $165 and immediately sell them at $190, pocketing the difference. It's like buying a new phone for $165 and flipping it on eBay for $190. Not a bad day, right? Unless you're the one trying to sell your phone on eBay and no one's buying. Then you will want to hit that like button for some good luck. But if the stock price falls below $165, the bullish trader can choose not to buy because they can snag it for a cheaper price on the market. No one's going to overpay for a discounted phone after all. Now, what about the bearish trader? Does this deal hurt them? Not really. Enter the concept of the options premium, which is the cherry on top for the Tesla Bear. This is an amount agreed upon at the start of the contract that compensates the bear for taking on the risk. The Tesla Bull pays this premium to the bear when entering the contract, and the premium is non-refundable. Basically, the bear gets to keep it no matter what. So even if things go south, the bear still walks away with something. For example, if the premium is $10, the Tesla Bull only gains 15 from the contract if the stock ends up at $190 after 3 months. The Tesla Bear's loss is also $15, as the $25 lost from the contract is cushioned by the $10 premium they received. If the price ends up below $165, the Tesla Bull loses the $10 premium and the Tesla Bear keeps it at profit. So, no matter what happens, the bear has a nice little cushion to soften the blow. In this case, the Tesla Bull is the option buyer and the Tesla Bear is the option seller. The option buyer has the right but not the obligation to exercise the contract, while the option seller is obligated to comply if the buyer exercises their right. In the example above, because the option buyer was bullish on the Tesla stock, they would be using a call option. A call option gives the buyer the right to purchase the security at the agreed upon price. In this case, the bullish investor buys the call option, while the bearish investor sells the call option. On the flip side, if the option buyer is bearish, they would use a put option. A put option gives the option buyer the right to sell the security at a predetermined price. For instance, if the exercise price is $165 and the stock closes at $140 after 3 months, the put option buyer can still sell the stock at $165 to the option seller and pocket the difference. However, if the stock closes above $165, the option seller keeps the premium. Now, how is the premium calculated? The premium of options is influenced by 3 main factors. First, the intrinsic value or moneyness of the option. This tells you how much in the money the option is. Second, the time value of the option. The further away the expiration date, the higher the time value. Third, the implied volatility of the option. The more volatile the underlying asset, the higher the premium. For the option buyer, the potential upside is unlimited, but the downside is limited to the premium paid. In contrast, the option seller faces an unlimited downside, but their potential gain is limited to the premium received. While the basic mechanics of options are straightforward, there are complexities in the financial world that go beyond the basics and might confuse a beginner. If you have ever been confused by all this, drop a comment below. You're not alone, I promise. That's why it's best to start with the basics and build your understanding from here. In a traditional, non-digital financial world, entering into such contracts could be quite complicated. Finding the counterparty, agreeing on terms, and taking the risk of the counterparty defaulting. It's like trying to arrange a blind date by calling around 50 people, hoping someone shows up, and then praying they don't ghost you halfway through dinner. But thanks to technology, this process is streamlined and can be done with a few clicks on most brokerages. You simply choose the asset, the exercise price or strike price, and pay or receive the premium quoted on the exchange. It's like ordering pizza online, no need to leave the couch, just pick your toppings and wait for the delivery. Next comes the art of profiting from options. Like any trading, it requires strategy for predicting price movements, whether using charts, data, or market sentiment. For example, in breakout trading, you would watch for a stock to break out and then buy call options, betting on its success. The key is to track the price of the underlying asset and trade when conditions are right. Unlike stocks, options can multiply your gains or wipe out the premium you paid. Premiums fluctuate based on price movements, so a $10 premium on a $100 stock could rise to $25 if the stock moves up by $20. That's a 150% return compared to a 20% gain on the stock. Options leverage small movements into big changes in premium, but also bring higher risk. A small dip in price can cause a 90% drop in premium. That's why having a solid system is crucial. Random buying and selling won't cut it. To succeed, focus on an underlying asset you understand well. With practice, you will build a system that's constantly profitable, but above all, manage risk. Great traders risk no more than 2% of their capital per trade. Start small, learn, and only then you will see consistent success. So guys, thanks for watching. Don't forget to subscribe, like, hit that notification bell, and see you in the next video.